In today's video, we are going to be analyzing one of the amazing properties of the Andrews pitchfork in alignment with the contextual price action reading, which is essential in order to spot high-quality trading opportunities. By the end of the video, I also want you to answer me a few basic questions about the institutional courses that have been under production since the beginning of the year. But before that, let's take a look at this piece of price action. The first thing you should be able to notice here is that the major flow of this market, meaning the price factors that are relatively large, are producing higher highs and higher lows, which for all intents and purposes means uptrend. That's an intuitive idea because when buyers are dominant in the market, they are able to raise the market to progressively higher levels, producing higher highs, and they are also able to pick the market up at progressively higher levels, and therefore producing higher lows as well. That's the most logical way of determining the trend or the dominant player of the market. Be careful, however, because the market is composed of several flows layered on top of each other, so identifying reversal points is a much harder problem because one flow will get in the way of the other. In the Price Action Trading Volume 1, I explain how this idea leads to the general consensus in finance that price moves in something called Brownian motion. That's a deeper subject that goes outside the scope of this video. Coming back to the qualitative analysis of what buyers and sellers are doing, it's always useful trying to understand what happens in the transition between price vectors or the transition between highs and lows. These areas contain a lot of information about buyers and sellers. This information might be useful in order to determine the future points where price might reverse. When we look at the transition between the last two major price vectors, we can see some interesting details. We can see a frequency line that catches some lower tails before and after the absolute major low. Notice how price touches this frequency line about 9 times before moving on to the creation of the absolute major low, and then after the major low, price returns to the frequency line once again. Take a look at the shape of the candlestick that touches the frequency line after the major low. The large lower tail and the bullish body implies there was a lot of buying pressure after touching the line. If you follow the free candlestick patterns course, you know that this is a hammer, which is a bullish reversal pattern. But if you follow my other courses, you also know that this is a fractal bar, which is a much more sophisticated pattern that abstracts some properties that are common to many of the classic candlestick patterns. The bottom line here is that price is encountering buying pressure in that line, and if that's the case, we might be able to use it in the future since price has a short-term memory. Since there is uncertainty about where price is going to land, we usually work with the idea of zones instead of just lines. In this situation, we can use this frequency line as the upper limit of a demand zone. The lower limit can be drawn incorporating the inward and outward frequencies of the absolute low. With that, we form a demand zone. So let's advance price to see how it reacts if it reaches this demand zone. Observe that price returns to the demand zone and it starts to behave in a particular manner. We can see the creation of two fractal bars, and one bar that has a larger lower tail after touching the frequency line we drew previously. That means price is indeed still respecting that line. At this point, we have price reacting to a specific region near a demand zone, which represents the possibility of a long trade. In order to help with entries and exits, we can deploy the Andrews pitchfork in a few different ways here. The most obvious way is by drawing a standard pitchfork using the most important alternating highs and lows in the chart, and assuming that we have the C-axis of the pitchfork in the most recent low. The other way is to use the same grounding positions, but using a modified shift pitchfork. Right away, we can see that the last fractal bar touches the lower line of the modified pitchfork, which can signal a long trade with a stop below the confirmed major low we saw previously. In terms of targets, we can also see that the pitchforks help because the center line of the standard pitchfork intersects with the upper line of the modified pitchfork more or less in the region where this trade would yield a 1-to-4 risk-reward ratio. This idea of producing a good risk-reward ratio is so powerful that it won a Nobel Prize in economics in 1990. William Sharpe developed the Sharpe ratio in order to measure the quality of an investment in terms of the excess return per unit of risk. That is a dramatic paradigm shift in relation to measuring an investment or a trade just by looking at its return. Given the situation, let's see how price develops. Here we can clearly see that price travels to the intersection between the center line of the standard pitchfork and the upper line of the modified shift pitchfork in a trade that would yield at least a 1-to-4 risk-reward ratio. That shows once again the power of uniting a contextual price action reading of the market with a tool like the pitchfork. There are much more details to consider in the contextual reading, and there are many other tools other than the pitchfork, as this is a vast subject. This concludes this analysis. Before we conclude the video, I want to give you an update about the institutional courses, and I also want to ask some questions about your preferences regarding these courses. As you may know already, I have been writing the review for the prerequisites you need in order to grasp the institutional trading methods. I already finished writing the review of basic linear algebra, which has only 115 pages. The review of differential calculus, which has 119 pages, the review of basic inferential statistics and probability theory, which has only 64 pages, and the review of integral calculus, which is almost complete and has about 136 pages. Next, there is the review of multivariable calculus, which is really important for the study of institutional trading. Basically, I already have 434 pages of review for the prerequisites. I don't mean to scare you with that, but you do need to understand these things if you want to take institutional trading seriously. You don't necessarily need to learn to calculate complicated things, but you need to understand the mathematical intuition behind a series of ideas. These books are designed to review all of these concepts in the quickest and the most effective way possible. You can easily go through each one of them in a day. The good news is that the prerequisites are much larger than the actual methods. And once you have the prerequisites under your belt, learning the institutional methods is actually easier than learning price action, for example. Applying the institutional methods is also a lot easier than learning them because they have a very robust mathematical and statistical apparatus behind them. There are about 5 institutional methods ranging from strategies used in hedge funds and derivative strategies used by banks. There are way more than 5, of course, but I have selected 5 of the more cost-effective, so to speak. One important thing here is that it's important for you to have knowledge in basic economics, microeconomics, and macroeconomics in order to apply the methods in the most effective way, especially the strategies used by hedge funds using stocks, currencies, and commodities. A knowledge about economics can also be useful if you want to align technical analysis or price action reading with an economic understanding of whatever it is that is happening now in the world. So beyond all of this material that is already underway, I will also create a course in economics. The other thing I wanted to tell you is completely unrelated to the institutional methods. I receive emails on a daily basis from people wanting me to develop strategies that are setup-based only because they feel uncomfortable with the subjectivity of contextual market reading sometimes. I wanted to ask you if you want me to create such strategies that are merely based on setups. I can do it if you want, but I can guarantee you that even though such strategies are possible, they have some caveats that most people don't expect. So please leave your feedback about that in the comment section. That's it for this video. If you want to learn about price action trading and the tools I showed in this video, please visit my website fractalflowpro.com. There you will have more information about the table of content of each course and the testimonials from students who already learned the techniques. If you like the videos I do and wish to support the channel, please click the like button, subscribe to the channel, share the video, and leave your comment below. Thank you for watching and take care.